everyone. I'm Emily Moore. I'm very excited to be taking you through our webinar, which is all about transition planning and scope 3. So we've got Martin joined by Simon and Aaron from Turners Automotive Group today. We have our first speaker, Martin Fryer, who's our head of strategy and disclosures at ThinkStep. Martin's going to take you through all the different types of reporting requirements that are relevant to Australia and New Zealand at the moment. And then we'll pass on to Aaron and Simon. So Martin, I'll hand over to you.
Thanks a lot, Em, and welcome everybody. It's a pleasure to present to you. My kind of introduction is very high level and very short because actually we want to get into the detail of Scope 3 and transition planning with Aaron and Simon from Turners. So I'm really just going to talk about some insights from the first 2 years of climate disclosures in outer New Zealand, but also reflect on our engagements. Obviously, we're working with Australian clients, and we've had the opportunity to work with clients with basically assets and operations around the globe. So we've been looking, obviously, at the international standard, IFRS S2, and how it's been kind of implemented and regulated across various jurisdictions. In terms of the way I'm going to present it, I'm literally just going to go through the 4 key areas of disclosure and pick out some of the disclosure requirements where I see a need for kind of an area of focus, certainly for New Zealand in year 3, but obviously these could be an area of focus for those who are earlier in the disclosure journey, because they will end up with far more robust climate-related disclosures. The first one in governance that I want to pick out is the requirement for describing oversight of climate-related risks and opportunities. And to do that or improve that, I think there needs to be more disclosure around how those involved in governance make skills and competencies available for this kind of oversight. It's quite difficult. Do they get external experts in? Is there some sort of skills training at board and executive management level? But I think that will be an area of focus for year 3. Oversight also needs to kind of disclose how climate-related risks and opportunities are considered and how they are considered in relation to strategy. Alongside that is actually the setting and monitoring of progress and achievement of climate-related metrics and targets. So how are those climate-related risks and opportunities actually discussed, considered, and provided with oversight at that governance level? That's what I kind of see as the key kind of highlights, opportunities, areas of focus for governance. For strategy, which is, as we know, by far the biggest area of the climate-related disclosure framework, scenario analysis can be time and resource intensive. And I think the area of focus really is actually potentially being more descriptive in how that scenario analysis has been undertaken. In particular, explaining the relevance of the outputs of that scenario analysis to the entity. So this was identified early on here in New Zealand with external reporting board guidance, where the guidance suggested that scenario analysis needed to be done at the entity level. And I think that is certainly a room for improvement in year 3, but certainly should be a focus for those who are starting out on the journey. Timeframes, describing risks and opportunities, how they might change over time. I think it's difficult to actually look at the timeframes associated with the physically changing climate, the potential transition to a low carbon economy, and match those to business, operational and financial planning timeframes. But certainly linking those changes to business and financial planning timeframes leads you through to that kind of transition planning aspects of strategy. And we'll talk about that a little bit later with Turners. Risk management, again, it's kind of looking at the risk management areas of disclosure to mature. A lot of early disclosures were really just a description and purely a description of the process of risk assessment. But I think we need to see additional information on the tools and methods used to identify and assess the climate-related risks and opportunities. So it's actually looking more closely at determining the materiality of the risks and opportunities, because it is only the material ones that really need to make it into your disclosures, and also linking that materiality across those time horizons and the duration of those time horizons. Integration into overall risk management systems, if you have an enterprise risk management systems, then that really should be used to assess the risks associated with all the climate-related risks and opportunities that you've identified. And I think there's room for improvement in terms of describing how that risk assessment is integrated into risk management systems. And then finally, metrics and targets. I won't get into a discussion around Scope 3 just yet, but just to reinforce really the disclosure of metrics and targets is for all material climate-related risks and opportunities. It's not just greenhouse gas emissions, although that has really been the focus in these initial years of disclosure here in New Zealand, and I'm sure it will be in other jurisdictions. But the metrics and targets need to provide a basis upon which primary users, which is the investment community, can actually compare entities within a sector or industry, and that's from New Zealand guidance. So it's really just improving the breadth of metrics and targets that are disclosed over time as you build up your understanding of climate-related risks and opportunities, and in particular, the material ones for your entity or organisation. That is my very brief overview. I now have pleasure in handing over to Aaron and Simon, who will talk about their experiences at Turners.
Thanks very much, Martin, and good afternoon, everyone. I'm Aaron Saunders. I'm the CFO of Turners Automotive Group. I've been 19 years in the broader business. I started out in Turners Auctions and then assumed the CFO role in the wider group in 2017.
Thanks, Aaron. I've been with Turners, I've got about over a decade's worth of experience, and I've been with the climate reporting from the beginning, so for 2 years. Aaron, perhaps you could tell us a bit about the company.
Yeah, for those who particularly aren't based in New Zealand, Turners, essentially we like to think of ourselves as retailers, but we are heavily in the transport sector and specifically the used car space. So we're the largest buyer and seller of second-hand cars in New Zealand. We've got about a 9% market share. But alongside that, we sell over 30,000 end-of-life vehicles, largely for the insurers, for insurance written off vehicles through our auto retail business. And then sort of filling out that auto ecosystem, we finance vehicles. So we've got a loan book now about 480 million, largely to Kiwi families buying and financing used cars. And we have a small insurance business that provides auto adjacent products such as mechanical breakdown insurance and comprehensive insurance. So we, whilst we're largely a buyer and seller of used cars, we kind of touch on a few other industries, and in particular, the finance business from a Scope 3 reporting perspective operates under some distinct finance standards known as PCAF. So we've ended up sort of developing a sort of a broad sort of cross section of understanding of different types of Scope 3 disclosures.
Yeah, we got introduced to climate reporting for the first time when it became mandatory for us, because we were eligible, being NZX listed and having a market value of over $60 million. And Aaron, talk a little bit about ESG position, Mike.
Yeah, so this is an interesting business in that the stuff that we sell generates emissions. The transport sector is one of the more significant emitting sectors in New Zealand. And our focus has really been on the things that we can control. So we do import secondhand cars from Japan in varying volumes. And we've kind of just focused on either importing lower emitting vehicles or reducing the total vehicles we emit to deliver on that first target.
Is that about 1,000 vehicles a year? Or?
Yeah, probably 1,500 vehicles a year. So we would make up maybe 3 to 5% of imports into the country.
Okay.
Yeah, we've kind of also, I guess, as a byproduct of the fleet getting newer, we've seen reductions in the financed emissions, and we pretty much focus ourselves on where we can make a difference through our operational emissions. And for us, the biggest area there has been swapping out our company car fleet from ICE vehicles, internal combustion engine vehicles, into hybrids, which is kind of in the business as you'd expect, but yeah, pretty close to 100% of that fleet is now hybrid.
As I mentioned before, we were new to climate reporting a couple of years ago, and we were kind of lost in the sea of all that, so we knew we needed assistance. And when you go out looking there, you can see there's no shortage of climate reporting consultants out there. So we did consider a few of them at the early stages, but then we thought it would take a different approach and actually ask a few of the people that we work with. And ThinkStep's name came up more than once. And so after a few conversations with ThinkStep, we engaged them to look at our carbon footprint reporting. Scope 3, sorry.
Yeah, we've spoken to a number of other listed companies in New Zealand just to get feedback on who they've used and what sort of experiences they've had. One thing I will say is the community here has been very supportive, and I think people are very willing and eager to share their time and expertise. And in particular, in the early stages for us, we used Deloitte to do some work for us. We used Chapman Tripp to review all our disclosures, and obviously a bunch of we've now done with ThinkStep.
Thanks, Aaron. So ThinkStep guided us through the process of working at our Scope 3. And initially we went through a screening exercise, which meant basically we had to evaluate all the emissions for all the categories. As you can see, if you see the page there, the ones in white are the only ones that we don't apply to us. And last year it was actually only 2 because we had a car subscription service. And for category 1, that's purchase goods and services, we had no idea on how to tackle this one. And so ThinkStep gave us a good guide, and we used something called a spend-based approach, which gave us some figures to put in there. Category 2 for us was slightly different. Most of our category 2 comes from our property development. And basically the project managers who look after our property have their own kind of company that looks after does the climate footprinting for that. So we use them for that, but then we pass it on to ThinkStep to incorporate in the report. And then the last 3 of the material categories there being 11, the use of sold goods, category 12, end of life, treatment of sold products, and category 15, which involves both our financed emissions and our insured emissions, involved large amounts of data. I mean, here's a kind of a slide here to give you an indication of some of the size of some of the records that we had to do. This is after we'd already screened out the ones that weren't relevant. So as you can see, category 11 is the largest, well, you've seen it on our next slide, sorry. Category 11 is the largest source of Scope 3 emissions by far, but category 12 had the most data points. It had over close to 80,000 records there that we had to do calculations on of various types. And it wasn't that straightforward. We have to use basically statistics from all sorts of sources, as you can see there at the top, from all those different agencies, and how to make sense of those and use them. And ThinkStep guided us through that as well.
Yeah, I would say that the ability to manipulate large volumes of data has been, very useful. Simon's background in the Turners businesses as CIO, so he has quite a bit of IT expertise, as you'd expect. And at inception we weren't anticipating the need to build data warehouses, but essentially we quickly realized we were dealing with so much data that we needed more than the ability to manage this in a spreadsheet. So we have essentially built and tested a bunch of data warehouses through the course of our sort of Scope 3 reporting journey.
Yeah, so we actually did a dummy run the year before we thought Scope 3 was going to be required. And then because we've actually got in place now, we just have to change some of the key statistics. We could produce it again this year. So we did actually disclose our Scope 3 this year, even though we weren't mandated to do so. As you can see here on this slide, so this is an excerpt of what ThinkStep provided us at the end. They gave us a full calculator, if you like, with all the details of how the emissions were calculated. And this is part of a summary that we got. And if you look at the right-hand side there, you can see how much category 11 dominates all our emissions. And that's basically all the emissions from vehicles that we sell. And to actually get some meaning for us, for our shareholders, we decided to lower our threshold below 1% for materiality to 0.25%. That way we could include things like our capital goods, which includes the property development and end-of-life treatment of sold products. And being happy with ThinkStep's assistance with Scope 3 emissions, we further engaged them then to help us out with our transition planning.
Yeah, so that was the second leg, I guess, of our engagement with ThinkStep. And again, it was an area that we didn't really know where to start. And I mean, I think what we valued through the process was just a kind of simple step-by-step walkthrough. So ThinkStep facilitated a couple of workshops with us. We involved 3 of our directors. And one observation I would make is that it was very useful getting people who are involved with governance in this business engaged early in the process of our climate kind of reporting journey. And one of the reasons for that is in New Zealand at the moment, directors have some personal financial risk and exposure to the quality of climate disclosures. But also, from a governance perspective, this is really does tie into strategy and risk management, and those really are governance functions. And certainly having interested directors involved early sort of made the process of then getting sign off for our reports that much easier. And that process was we were pretty much led through that by ThinkStep. And obviously we're the experts in our business, but some of the methodologies and the approaches, we're quite happy to take advice, and that was where the value was added through ThinkStep and Martin in particular.
Yeah, I mean, we weren't even sure what level of detail would make sense in the disclosure. So what they gave us a summary report. It looks a bit like this, which was basically what we almost used as it was in disclosure itself. So if you look on this side here, that's basically just manipulated with a bit of formatting, and then that's what we end up disclosing, which was made it really easy for us, all the heavy lifting being done. If you look a little bit on the second one there, so it wasn't just about risks, it was also about opportunities, and some of these we hadn't actually and really thought about or uncovered before. Aaron, perhaps you want to just talk about bit of that.
Yeah, definitely. I mean, I think we mentioned earlier that we have a business selling cars at the end of their life, either insurance write-offs or cars that are simply uneconomic to repair. But some focus on the opportunities posed by climate change for us really, I think, helped us and firmed up our investment intentions in that area of our business. And even just looking at the underlying numbers, the New Zealand light vehicle fleet is about 4.5 million vehicles. 20% of those vehicles are over 20 years old. So there's about 900,000 vehicles that are over 20 years old. And that presents a significant opportunity for us, but both in being able to assist in the recycling of the materials in those units, but also in selling a replacement vehicle to someone. And it's rare that someone goes from a 25-year-old car to a brand new car. So there's normally a step in the middle, or two steps in the middle there. So I would say a big part of the value from this process is spending as much time focusing on the opportunities as you're spending focusing on the risks, because there are definitely opportunities to be teased out of this process. And I think the other area of insight for us really is around the circular economy and the role that we play in that. So there is about 90 to 95% of the components of a car that can be recycled, and the materials can be repurposed in an economically viable way. And we form a part of that ecosystem. But also from an emissions perspective, using cars for as long as they can be cleanly and economically operated in the fleet is actually a good thing from an emissions perspective, because somewhere around 35% of vehicle lifetime emissions actually come from the manufacturing process. So whilst the way emissions are measured for New Zealand pretty much puts the weighting all on their use, there's a whole bunch of emissions that happen, somewhere else, be it Japan or China or Korea or America, wherever those vehicles are manufactured. And from a global perspective, that's obviously an opportunity.
Thanks, Aaron. That's great. So we've already touched on some of the opportunities in the previous slides, and we uncovered others as well. So, for example, when we do our property development, we were quite surprised, because we'd never had done the carbon footprinting on that before, that in those sites where we reused existing infrastructure, there's the massive reduction in the carbon footprint was very significant. So that's another reason for us to focus on reusing existing infrastructure like the concreting and the buildings to keep our carbon footprint down. And since we've gone climate reporting, we've taken on more in-depth flood risk assessments on prospective sites, which has been, I know it's kind of been in the news anyway, but we'd now take that to a much higher degree, looking at what the potential flooding and other risks are of sites before we sign on the dotted line. I don't know if there's anything else you wanted to comment on there, or.
Yeah, I mean, I think again back to that kind of opportunity space for our business. One of our big realizations is that in the short to medium term, we are probably a net beneficiary of climate change, and that things like flooding events typically result in vehicles being written off. So in a newish vehicle, you get any water in the floor plan, and the vehicle has to be written off because it affects the electrics. And so given those events and the perhaps the increasing frequency of those events, our end of life business and our replacement car business become beneficiaries from climate change. And again, it kind of helped us prioritize some of our investment decisions.
Thanks, Aaron. So we're getting close to the end now. One of the things to talk about perhaps is some of the lessons learned, and it certainly helped having the right expertise available to sound ideas off. This intellectual rigor to the process, which enabled us to develop, relatively simple logical outcomes. Transition planning also allowed us to get insights outside of our normal strategic planning because there were such longer timeframes, and also went through lots of different range of scenarios that perhaps might be, they're kind of quite extreme, but they're still worth considering as a thought experiment and looking at what effects they might have. I mean, things we wouldn't have thought of was things like climate refugees and what impacts they may have, or even if they force the early adoption of fully autonomous vehicles, and that's accelerated due to climate change, what effect that might have to us and things like that. So maybe just to wrap up, let's talk about what it was like working with ThinkStep. We did cover on it briefly earlier, but what are your thoughts on the experience, Aaron?
Yeah, I mean, I think it's important when you're choosing partners in this space that you do share perhaps values. And I mean, we found working with these guys, key thing was they're very pragmatic and practical. And whilst independent experts in climate and emission reporting and sustainability reporting, they are not preachers. And so that was a kind of a refreshing change for us, I think, that working with someone who wanted to get alongside you, understand your business, and then perhaps tease out some of the opportunities that change does present, rather than take a sort of a more what I'd perhaps describe as a purist's approach. So, in addition to that, the benefits of publishable quality outputs from the workshops and processes that they ran were significant for us. We run a pretty lean head office. There's 6 of us here, and so just having someone be able to come in and take on a chunk of that reporting burden was particularly beneficial for us.
Yeah, we haven't got a large team working on the report, so it made it much easier when someone was doing all that heavy lifting.
Yeah, definitely.
So I thought we'd pass it back to you, Emily, now. Yeah, back to you, Emily, now for the Q&A, if that's okay.
Yes, that is okay. Thank you so much, Simon and Aaron, for that presentation, and Martin as well. Yeah, I really actually liked how you have that focus on, not just what risks are we identifying through this process, but also the opportunities that exist for Turners. I thought that was a really cool spin, and yeah, really making the most of the analysis. So that's really great. Cool. We're open for questions now. So I've got a question here from Adam. So this might be directed more to you, Martin, in terms of, I assume this is relating to the general process. It's about transition plans. So is the transition plan structure, does it go from risks and opportunities to anticipated impacts to actions? Is that the way that you'll describe that flow?
Yeah, fundamentally it is. There are a couple of additional steps that I'd recommend. So obviously, the scenario analysis leads to the development of your kind of long list of climate-related risks and opportunities, but you need to actually assess those in terms of materiality, because that can be a very, very long list and you don't need to disclose all of them. You don't need to take them all into your transition plan. So there is definitely a materiality assessment that needs to be done based actually on those anticipated impacts that you've mentioned there, Adam. And then when you've got that kind of short list or shorter list of material risks and opportunities, it's then understanding, yes, what actions are you going to take to manage those over the short, medium, and long term, over those time horizons? Who might be involved? Who are the internal stakeholders? Who's going to be responsible? What sort of resources might be required? And also, we had a look at some different kind of global guidance, and quite a few suggested including in the transition plan what they call triggers. So what would trigger you to actually review a risk or an opportunity? Because in theory, once you've got those risks and opportunities identified, it then goes into a kind of annual review process. So at that annual review, or maybe even sooner, what's happened in terms of the transition to a low carbon economy? Is that going to trigger you to review and update the materiality of a particular risk or opportunity? Or have we actually started to see the physical climate changing more rapidly, and therefore we need to reassess physical risks?
Perfect. Thanks, Martin. Hopefully that clarifies a little bit for you, Adam. Got another question from Tim. So Tim asks, what are the key actions Turners might take to reduce their reportable Scope 3 emissions? So I might throw that one to you two, Simon and Aaron.
We did touch on some of them.
That's a great question,
But yeah.
Tim. I mean, 96% of our Scope 3 emissions come from the way that our customers use the assets that they buy from us. So that's a little bit of a challenge, in that there's a customer behavior aspect to that. And we're not in the business of telling our customers that they shouldn't drive their kids to school. But what we can do is shape the vehicles that we do sell and reposition where we can, particularly the vehicles that we import, into lower emitting vehicles. So we, as I said, we're not in the business of changing our customers' behavior, but we can certainly influence the products that we offer to them to some extent. And also, particularly in spend-based areas, so through operating and capital expenditure, we do, have much more control. And Simon kind of touched on the significant carbon savings you can make from repurposing buildings, for instance. And we are kind of regularly in the business of developing yards to operate from, and we have seen some really quite significant savings by, as I said, turning warehouses into showrooms, for instance, as an example.
Perfect. Yeah. So it seems like there's quite a bit of room for you to tackle those emissions. And it's also good that you can identify what you can have influence over and what you can't. That's a really important part of it as well. So fantastic. Thank you for the question, Tim. We're at time, and I think we've gotten through the questions. Oh no, hang on, we've got one more for Martin. So I'll ask this one for you, Martin, and then we'll wrap up. So Stephanie asks, how have you seen entities integrate climate risks into their ERM when climate risk timeframes are longer and methodologies for rating the risks may differ from the normal likelihood X impact?
That's a really good question. I will try and answer it succinctly, which is going to be difficult. But we've obviously worked with a range of clients, some with an enterprise risk management system, some without. And yes, even those with an enterprise risk management system have actually looked at rating climate-related risks and opportunities using a slightly different methodology. As long as at the end of the day, the internal stakeholders are in agreement around how that risk assessment is undertaken, and they agree in terms of what the material risks and opportunities are going forwards, that's fine. The time frame one is always a challenge and will continue to be a challenge, because as I said earlier, the time frames associated with a physically changing climate and the transition to a low carbon economy are very different to your normal kind of business planning time horizons. Having said that, organizations that have a short term of 1 to 3, maybe look at 3 to 10, and then 10 years beyond, that is actually taking us well beyond 2030. And obviously 2030 is a crucial date around the transition, the Paris Agreement, etc. So there are ways of linking those long-term time horizons back to strategic planning within an organization.
Awesome. I think that was very succinct. So thank you, Martin. As succinct as it could have been. So that's great. Yes, we'll ask this last one from Tim, and then we will wrap up. So Tim asks, apart from the mandatory requirement, has Turners found that doing a Scope 3 inventory has incentivized any parties to purchase vehicles? So is there any connection between sales and Scope 3?
I'd like to say yes, but I'm not sure that I can be definitive there, Tim. So we elected to disclose our Scope 3 emissions early, and we've had some feedback from that, but it would seem, and I'm probably talking more investor feedback than customer feedback, it would seem that there's some discomfort really around Scope 3 and how you measure boundaries, and I think the number of assumptions that entities in some cases, including us, are having to make to produce those numbers. So the most focus really for us has been on two things: Scope 1 and 2 emissions, over which we have much more direct control, and also how much it costs us to produce our climate reports. So those are probably the most feedback that we've had in relation to this.
Awesome. Thanks, Simon. That's great. Thank you for the feedback as well, Naleshni. That's very, very kind. I just want to say thank you to Simon and Aaron and Martin again for your time and for sharing some wonderful nuggets of wisdom with us today.
Thanks.
Everyone. Bye.
We have many more webinar replays on a whole host of sustainability topics. You can check them out on our website and our YouTube channel.